All right, less than 3 minutes left until the closing bell. Joining us from the CME Group in Chicago, Michael Gurka of BruinHill Partners, who trades global equities, ETFs, and commodities there. Also with us is Nicholas Colas, Chief Market Strategist at Bank of New York Mellon ConvergEx. Nicholas says, looking ahead, we have to watch the Fed on Tuesday because right now it looks like they are out of bullets to fix this economy. And let's, Nick, talk more about that. I mean, a lot of people have been talking about quantitative easing today. You think they just have nothing really left?
Yeah, it doesn't feel like they have a whole lot left. If you look at the yield curve right now, I don't think we can say money is expensive at any point in the maturity scale. It isn't the cost of money holding us back. It's a desire to borrow money to grow the economy and to add jobs that's really holding us back.
So even though there are things they can do, which we were talking about earlier with John Herman, you don't think they're going to have much of an impact?
No, and I think they've tried to telegraph that, in a subtle way over the course of the past couple of testimonies from Chairman Bernanke and other Fed governors and so forth. There isn't really a whole lot left that can move the economy forward. They've done a lot already.
Michael Gurka, are you guys used to that idea? Are you waiting to hear something similar from the Fed?
We are, but it's been very redundant on how that's been coming through the market. So right now, no surprises, the same story quarter after quarter. And as much as we want to focus on job growth, really, it's productivity. And more importantly, what you were just mentioning, I think the way that container ships, of course, the dry bulk index is something that we watch. It really influences the way I make decisions in copper. And I start seeing this commodity trade start to top. I think it all comes together and more of a W than a V.
What does that mean for the equities markets, Michael?
I think unless we see the broadest of measures being the Russell 3000 get above and close on a weekly basis against 665, I think we've just found another range that we do very well and rally against and then fail and start to consolidate again.
By the way,
there's a lot of talk in the market about blowing out to the upside. I just can't see it yet.
Why do you step back, Michael, and take such a huge look at the market, the Russell 3000 there?
Well, first of all, one of the biggest concerns I had is when the market was falling apart, we were starting to look at 20-year charts going back to 87, finding out where's the knife going to be caught after the drop. For the same reasons, you just cannot forget those charts and look at some of these levels. And 1- and 2-year weeklies are really important to me right now. And I think that's why I look at the broader measure, because right now we've had breakout confirmed right now in the NASDAQ and in the S&P. I think now with the Dow being in between, I look at the broadest measure we have, and the Russell's that big confirmation if the move is for real.
Back now to Michael Gurka and to Nicholas Colas. And Nick, we talked about it with you and Michael. Zara mentions it too. Quantitative easing is really on the tip of everybody's tongue. It's kind of scary, actually, though, if the Fed doesn't have any bullets left, no arrows in its quiver. I mean, what are we to do as the economy isn't recovering at the speed that we'd like it to?
Yeah, it's exactly the right point to focus on. I mean, I say that when the sheriff's out of bullets, maybe you should leave town. That's kind of the problem that we have currently. The other answer, the longer-term answer, is it just takes time. We've eroded a lot of confidence both among individual investors and among the population as a whole as far as consumers go. It's just going to take time to recover. There's no easy fix. There's no short-term fix. It's a combination of low interest rates, maybe some further stimulus from Washington, but more than anything, just time.
Hey, Nick, it's Dominic here. Just on the interest rate front here, looking at this, we obviously came off the lows in the stock market here, but we didn't see any kind of a real rally in terms of the yields, so to speak. The 2 years, again, a record low. 10 years, weak all day. Now, just checking my charts, 2.81% here. I mean, is there any situation here that the markets are getting it wrong on the equity side and the bond guys got it right?
Well, certainly, I think the major reason for that dichotomy revolves around expectations of inflation, disinflation, or deflation. I think the bond market is pretty much convinced there's at the very least further disinflation, if not outright deflation. The equity markets are looking at low interest rates and saying, well, maybe they're low enough to start engaging something in the economy. I do think that the bond market does have it right when it comes to disinflation and deflation. I think it's very hard to envision any kind of real price pressure to the upside over the next 6 to 9 months at the very least. Because of what we see in the economy with all the stock capacity that we have.
Question, I got to follow up on that. If, in fact, the bond market has it right and yields are 2.82% and it's deflationary, is there any argument to be made for buying stocks? Because, in theory, if it's deflationary, there's no growth.
That's absolutely right. It's going to be very hard to generate growth. I do think as a result of the numbers this morning and what the Fed says next week and the revised GDP numbers later on in the month, you are going to see analysts begin to cut estimates for 2011 and beyond. And I do think stocks perhaps aren't as cheap as people think. The short answer to your question is much rather be in the bond market as elevated as it is rather than in stocks right now.